So this chapter has to do with investing and the stock market. There are three topics, uh, passive versus active investing, and then what they call how to really pick stocks seriously, which is basically general ideas of stock market strategy in terms of investing, and then a discussion of benefits and costs of stock markets more generally. Active investing refers to people who pick individual stocks. So they're really, when they said active in the market, saying, oh, they're going to buy a few shares of IBM one day, sell a few shares of Exxon the next, etc. A passive investor is someone who picks a group of stocks, a broad market index, and generally sits on it. Passive investing makes up, in terms of in a typical year, if you invest in an index about the S&P 500, which is 500 of the largest companies in the United States, and you just follow the index, you're going to beat about 60% of mutual funds. Mutual funds can be focused on something that's very narrow, small cap stocks, or something in mining, for example, or some mutual funds can be fairly broad-based as well. So if you invest in a mutual fund, you've got about a 40% chance of beating the S&P 500 any given year, a typical year. But over a 10-year period, a study has found that you have less than a 3% chance of beating basically the S&P 500. But that is kind of unusual then, that a passive investor over the long haul is going to beat very much active investors. So here you can see on a typical year the percent of mutual funds that were outperformed by the S&P 500. And it varies quite a bit from year to year, but in many years it's well over 70-80%. What about so-called stock market experts and gurus? We know that there are TV stations like CNBC and Bloomberg, which people watch and try to glean information about how to invest in the stock market. There's the story of Warren Buffett. Is he a genius? Is he just lucky? Or is he a little bit of both? Well, this example in the next figure is something kind of provocative. Say that you had 1,000 people and they flip a coin. Half say the market's going to go up, half say the markets are going to go down. And we'll abstract from the possibility that the market doesn't move at all a given year. Well, after 1 year, 500 of those people are going to be right that year, 500 wrong. They flip the coin again the following year, the 500 who won, who were right the first year, they flip the coin in the second year. Well, half of them are going to be right, half wrong. Now you're down to 250, and you repeat that process, and you'll find that after 5 years, there will have been 31 people out of 1,000 who were right each year. And so the idea is that even if it's completely random, if it's a coin toss, being right or not, there's going to be people who repeatedly are correct just by laws of probability. So maybe the people are geniuses, maybe the people are just lucky. Why is it so hard to consistently beat the stock market? Well, the idea is related to something called the efficient markets hypothesis. So the last few slides here explain how that works. The efficient markets hypothesis is a hypothesis about how market prices reflect information. And the idea is that buyers and sellers should have access to very similar, if not the same, information. We'll release that assumption in a bit. If on average, over time, buyers and sellers have access to the same information, then consistently buyers are not going to outperform sellers and vice versa. So let's say that people believed in general that the number of senior citizens will double in the United States by 2020. Well, maybe a winning strategy then is to buy stocks in companies producing goods that senior citizens want. But if everybody's aware of the fact that senior citizens are going to double, the number of senior citizens is going to double by 2020, why would anyone sell their stock in such a company? Which basically means that the sellers are people not who are stupid, but people who are realizing that the stock price already reflects the expectation that senior citizens will double in their numbers by 2020. So the conclusion based on this idea is that the only way that you're really going to be able to outperform market is by having inside information, to having better information. Consistent beating of the market based upon having better information means that you have some kind of inside information. And of course, we know insider trading is illegal. Now, it could be the case in complicated situations where the market may be assessing a particular probability of an event occurring, but you have assessing a different probability of an event occurring, and you might be right. But are you going to be able to be right consistently? That's the issue. The only way you're going to be able to consistently right and systematically outperform the market is that you have systematically had inside information. And doing that consistently is fairly easy to detect. So the efficient markets hypothesis states that prices of traded goods, including stocks, reflect all publicly available information. Which basically means that if you're going to win, and when new information is revealed in the market, you're going to have to act very quickly. Your textbook gives the example of the meltdown at Chernobyl back in the 1980s. When that accident occurred in Russia, in the Ukraine, in the 1980s, immediately the shares of nuclear power plant companies in the United States fell. The price of oil jumped. And potato prices also rose because the local potato crop was going to be damaged. In other words, markets react very quickly to these changes. So if you're going to be perhaps a flash trader trading on new information, you may be able to make some money, but you either have to have anticipated that Chernobyl was going to melt down and traded on that successfully, or had inside information that it was going down before other people did. There's a very large cadre of very high-paid mathematical types on Wall Street and in other investment firms around the world that are engaged in trying to find patterns in stock and asset prices. That's called technical analysis. It's very sophisticated math, and even the analysis of these stock picking algorithms has found that none of them has systematically beaten the market over time. Doesn't mean that people don't keep trying, because there is the belief that perhaps that they may find the holy grail of stock picking down the road. Anyhow, the notion of the efficient markets hypothesis is something that we need to come back to, because some people will interpret it as meaning that stock market bubbles themselves cannot exist. Other people try to reconcile the existence of efficient markets hypotheses with stock market bubbles, and we'll come back to that a little bit later.